Hey, what's up everyone? This is Silver Slayer. Thank you for tuning into this video. So, right now, gold is the perfect hedge against inflation. The COVID-19 virus spreading really exposed the amount of debt that we are in on a global scale, right? Recession is looming, and this could be the icing on the cake that really does top things off. So this video is going to be talking about 3 trends supporting gold as a hedge, 3 different reasons why gold is the perfect hedge. And when I talk about gold, I also mean silver, and actually more specifically silver, as there's more potential, more opportunity in that metal compared to gold, especially since the gold to silver ratio is sitting at 103 to 1. So before we start, make sure to smash that like button. Make sure you subscribe if you are new. I post daily videos. Every single day I'm posting a video. It's the perfect way to stay up to date with what's going on in the world of precious metals. I am your guy. This is your channel. So anyways, let's jump into this article. The summary is, while gold didn't do much during the sell-off, acting more as a store of value than a negatively correlated asset, this is starting to change. This is starting to change nowadays. We are starting to see this more of an asset. Not such a bear market and not just valuable because it's shiny. Gold tends to do best when investors are worried about too little growth, right? Gold is this safe haven in demand. Gold and silver are the safe haven asset that people drive in times of economic turmoil. So during the past decade, the changes in real interest rates have explained more than 30% of the change in the price of gold. So the point of owning insurance is that it will pay when needed. For investors suffering through one of the most abrupt corrections on record, their insurance policies have a mixed record. In early February, I suggested that U.S. Treasuries, despite near record low yields, would still prove an effective hedge. Since the start of the stock market correction, long-duration U.S. bonds have gained 8%. But what about other favorite hedge, which is gold? While gold didn't do much during the sell-off, acting more as a store of value than a negatively correlated asset, this is starting to change, with both nominal and real inflation-adjusted real interest rates in free fall. Gold is well positioned to do what it is intended to do, help insulate a portfolio. Here are 3 reasons why gold should continue to act as a hedge against equity market risk. See, other investments are a lot riskier, especially since they're pegged to the dollar. They're pegged to a system that is failing. Gold and silver have real value, intrinsic value. That's why it's a perfect hedge against inflation. Stock markets are pegged to the dollar. They're pegged to a system that's crashing. So it's like switching seats on the Titanic. You're still investing into something that is collapsing at the end of the day. So I recommend precious metals that have been a store of value for over 6,000 years, much longer than our newborn baby, which is a fiat currency, has been existing. So the dollar is collapsing. The dollar index DXY is down nearly 3% since the market's mid-February peak. This is important as gold's efficiency as a hedge is partly a function of the dollar. While gold can do well even when the dollar's rallying, historically its outperformance is strongest when the dollar's down. And that's true. When gold and silver are up, the dollar index or the dollar's value strength is down. When the dollar index is up, gold and silver are down. There's like this ping pong match going on, right? So that's really important to think about, especially since President Trump said himself he wants a weaker dollar. He said the dollar index is too strong. So, number 2, growth expectations are falling. As I've discussed in previous blogs, no hedge works in all circumstances. The catalyst matters. Gold tends to do best when investors are worried about too little growth. For example, in months when volatility spiked in the ISM New Order Index, a survey of manufacturing activity rose, the median returns to gold versus stocks was 2.75%. If you instead focus on periods when the ISM was falling, suggesting a decelerating economy, the median return increased to 5%. In those months when the ISM survey was falling particularly fast, as it is today, the median return versus stocks increased over 8%. In other words, to the extent of the coronavirus represents a threat to growth, gold should be particularly effective hedge. And it's going to come full circle. Even if coronavirus or COVID-19 is hurting prices right now, that's because every market's getting hit right now. And it's going to come full circle, especially since the U.S. Mint sold out of their coins. We're seeing a shortage of silver. Industrial demand is booming, and we need silver. The supply will not be able to meet the demand, and that's what's going to boost prices. So number 3, real yields are collapsing. Neither a weak economy nor a sinking dollar will help gold if real rates are rising. Today, however, we have the exact opposite. The U.S. 10-year Treasury real yields are 0.45% down, more than 0.3% in less than a month. You can see the chart, the first chart. So, this is historically, this is the direction of real rates has the highest correlation with gold's performance. Since the onset of the financial crisis, this relationship has only strengthened. See, it's only getting stronger. During the past decade, changes in real interest rates have explained more than 30% of the change in the price of gold. As a rough rule of thumb, every 0.1% drop in real rates coincides with about 1.25% increase in gold. Based on this relationship, gold's poor performance during the week of the 24th should continue to reverse. So they're saying that it's almost going hand in hand. There's actually a correlation between interest rates dropping and gold's price rising. And if there's an exact correlation, then you can expect gold to rise. Right now, there's just so much happening. There's a blindfold over. So lower growth rates equals holding gold. Beyond the human toll, the biggest threat stemming from the coronavirus is to the economy. A combination of disrupted supply chains, less travel, and dented confidence represents a threat, potentially a serious threat to the economic growth. Under these circumstances, investors may want to consider holding gold. I definitely think gold, and this is why you always see, SHTF survivalists, SHTF preppers, doomsday preppers, apocalyptic preppers. They're always holding silver and gold, more specifically silver, because it's more convenient, right? Gold is too expensive. In times that you need to barter and trade, silver is the ideal metal. So with that said, why? Well, because silver is fractional. It's a lot cheaper than gold is. Gold has its benefits for some reasons. You can fit $100,000 of gold in a shoebox. You cannot do that with silver, right? You cannot do that with silver. But silver is a much more convenient, and convenience is key in these situations. In times of economic turmoil, convenience can be the difference between life and death. And silver is just more convenient, flat out. It's cheaper. It's more easily attainable. It's easily bartered. This is historically going. If you look at the historical patterns, it's the same thing, right? Back when people did barter and trade, even in biblical and Egyptian times, they used silver. The ratio was 2.5 parts silver equals 1 part gold. Silver was the necessary means of trade. And today, if a recession does come along and destroys the dollar, the same thing would happen. It would be bartering with silver. Gold is more for coinage, silver is more for technology. And the funny part is people see gold more of an asset and silver more of a commodity. I actually think it's actually the opposite. Silver is more of an asset. Gold is more of a commodity. Gold is used more for coinage, more for jewelry. That's why so much gold is recycled and reused and rescrapped. Silver is lost in technology. So even though the gold to silver ratio is 8-to-1, it's actually much, much smaller looking at the reality of it. So anyways, these are some of the reasons why gold and silver are the perfect hedge against inflation. The dollar's lost 98% of its purchasing power due to inflation. It's basically worthless now. We're pumping these useless dollars into a system that's trying to get ourselves out of debt by replacing it with more debt, and that's never going to work. That's like trying to pay off a credit card with another credit card, and you're just going to see the same thing happen over and over and over and over, and that's fiat currency that's failing. It's never going to work. It's not designed to work. It's designed to fail. It's going to collapse sooner than later. And that's why you need precious metals in your portfolio to protect yourself from this, because stock markets won't protect you from it. Real estate won't protect you from it. Cryptocurrency won't. So precious metals are the answer. Actually, there is no solution. There is an alternative, and precious metals are the alternative. This is not fixable. We're not going to fix this problem. Lowering interest rates isn't going to fix the problem. Raising interest rates isn't going to fix the problem. We are too far in debt. We're $24 trillion in debt, and there's nothing we can do about it. So anyways, not to scare you, but that's the reality that we live in, and that's also why it's so extremely important to invest into precious metals for the given reasons. So anyways, I'm going to wrap this video up here. I hope you guys and gals did enjoy it. If you did, make sure to smash the like button. Also, make sure you subscribe if you're new, because I do post daily videos. The link to this article from Seeking Alpha will be in the description if you want to check it out yourself. This was Silver Slayer. I'll see you guys soon. Peace.